Well, good afternoon, everybody. So, recently I was reading an article. It was out of CNBC, and the gist of the article was basically that the wealthy are currently preparing for tax increases. Now, there's a lot of reasons for that. We got the government spending is soaring, both at a state and a federal level, and revenues have been dropping like a rock with everything going on with COVID. So that really only means one thing for us. It means monumental tax increases are probably right around the corner. Now, welcome to this week's Market Huddle. I'm Joe Lucey. Most of you have know me. I'm president of Secured Retirement Financial, and we've been doing these now since March 23rd. Every Monday we get together and talk about something topical. Now, the one thing that I thought was important to go over today is that we have to recognize that while the wealthy understand that taxes can be absolutely deadly when it comes to our retirement, and they do everything they can to help minimize their taxes, most Americans just don't take advantage of some of these things that are out there. See, many of these strategies that the wealthy are using to save a fortune when it comes to taxes are also available to you and me. So that's what I want to talk about here today. It's about simply taking advantage of some of these things that are available. Today on this Market Huddle, we're going to talk about 5 different tax planning strategies that the uber rich or the wealthy are using that can also help you save a small fortune when it comes to your taxes, including the single most important key to saving taxes that most Americans just simply don't plan around. I'm going to talk about a tax loophole that is currently out there that can save you a windfall in savings, and some overlooked stealth taxes around things like Social Security that we want to make sure that we're avoiding. So with that said, I'm going to go ahead and get our PowerPoint up and running. And we'll do that so that we don't have the slide up there. And again, today's Market Huddle, August 10th, 2020. 5 planning strategies that we can be using that the ultra wealthy are using to help save them a fortune in taxes, and something that you and I can start to look at as well. So here's the disclaimer that we share every time. Just keep in mind, I'm going to be talking about things like taxes and increasing taxes, and some of these are somewhat forward-looking. I have no idea where taxes are going to go, but I think as we go through this today, you'll recognize as well that now might be the best time to start looking at how we can put ourselves in a better situation. So, first of all, understand that when it comes to tax planning and what the wealthy are using to help them save a small fortune, it really starts with this concept of tax planning. Now, most Americans, they just simply prepare and they file their taxes every year with an accountant or CPA, an enrolled agent. When they do that, they're really just kind of reporting history. Now, if you want to start saving a whole lot of money in taxes with your retirement, you need to start looking forwards, doing a look forward tax plan, not necessarily backwards. So this is how we've helped a lot of families keep their hard-earned money. And the analogy I like to sometimes use is tax preparation is really like reporting the score of an athletic event. You know, the Minnesota Wild are recently knocked out of the playoffs here, but if I'm just keeping score, it's about things that have already occurred, something that just happened. Tax planning is more about the coach on the bench. What did we do before the game? How do we start putting things in order so that we can start to save a boatload of taxes? One thing that you want to make sure that you recognize is that we are very likely going to see taxes going higher in the future. Now, according to Fortune, and this is just from it was April 20th, the trillions of dollars that we have been borrowing at a pace like never seen, the U.S. is endangered to lose its sterling credit status that makes treasuries and the dollar the safest havens of global investors, and it's likely that within the next decade, the U.S. may even have to impose monumental tax increases to avoid some of the credit hits that we might see. In fact, Forbes goes on to say that taxes are probably going to double over the next 10 years to pay for the ballooning national debt, swollen Social Security, Medicare rolls, etc. So for most people, the enormous unfunded liabilities of the federal government, a lot of them are linked to ongoing retirements of the enormous baby boomer generation. So basically, it's our fault and what we're spending, and obviously a lot of what we have had going on here with trying to address the stimulus. We recently passed $3 trillion of stimulus between 3 different acts, including the most recent, the CARES Act, which was the Coronavirus Act. That gave everybody $600. Most of you probably heard over the weekend that President Trump signed another $400 for unemployment. All of that is starting to increase our national deficit. In fact, if you go to usdebtclock.org, you will see that our current national debt is sitting at $26.6 trillion. Now, if I compare that to where we were at just at the beginning of the year, we are up a little bit better than $3 trillion. If I go back 3 or 4 years, we were under $20 trillion. It's growing in an enormous effect. And in fact, CNBC has recently said that the marginal tax bracket could jump as much as 46% after the current tax cuts expire, which is going to be in 2025, January 1st. On top of that, it's not just the federal debt and the federal taxes that I get concerned about. It's also planning around the Minnesota, Wisconsin taxes. We got a lot of pressure right now due to the pandemic, pensions, healthcare expenses of retired workers. There's an overhang here that is going to eventually have to be addressed. We really have, when it comes to planning and what the uber wealthy are doing to make sure that they are planning around that, is they are looking forward and starting to do some proactive measures to start to address their taxes today. We've got the $26 trillion in deficit that's up from 23 in January. We got interest rates that are extremely low. We have 10% unemployment. We got Social Security, Medicare costs are rising significantly. In fact, 45% of our national expenses are the deficit that we're creating go just to our 45% of our tax revenues just go to Medicare and Social Security. As we start to see interest rates go up, we're going to start to see it. It's no longer, in my opinion, a matter of if we're going to start seeing taxes going higher. It's really a matter of when. Now, we all know that the current tax rates we're in have an expiration date, much like a milk in the fridge. There's a date that's stamped on it. We know that probably the best case scenario right now is we're looking at December 31st of 2025. However, we could see something even sooner than that. I guess a lot of that might depend on the elections and what have you that are coming up. So a lot of people, I don't think, realize it, but I think that right now taxes are lower, or they are lower, it's a fact, than they have been in over 40 years. And while many experts, CPAs, economists agree that taxes have to go up, this is all happening just as we get to where all of us boomers are starting to retire. And it's going to end up taking a large chunk out of your 401k, your 403b, your Social Security benefits, and so forth. So there is some good news. There are some simple tax planning strategies that you can start to employ. We just have to be proactive. We need to start doing some tax planning around our taxes, just like the wealthy do with their tax planning. And we can help you with that here at Secured Retirement with what we call Secured Retirement Tax Smart retirement analysis. So at the end of today's presentation, if you're a client of ours, I encourage you to schedule some time to review this if we haven't sat down in a while. If you maybe have been lurking and then watching these webinars here for the last few months, and maybe now's the time that maybe the timing's better. Just schedule some time at the end of the presentation. Let us show you how bringing in some tax planning can make a significant difference in your retirement planning. And if you've been referred by a client of ours, a lot of our clients are are taking these presentations, the recordings, or forwarding them on to somebody, feel free to schedule your own 15 to 30 minute tax smart retirement analysis at the end of the presentation here. We'd love to spend some time and show you what some tax smart planning can do for you. Let's move on to the next thing. We're talking about the 5 different areas of planning that the wealthy use when it comes to their tax planning that we can be using as well to help put ourselves in a better situation tax-wise. The first one is just to start to do some look-forward planning. The next one is really, you've got to start thinking about how we're going to start to withdraw money from our IRAs and 401ks. All too often, when somebody visits with us for the first time, we'll say, what kind of plan do you have in place for how to take this money back? We've been trained for years that let's wait as long as possible to take our IRA money. But keep in mind, IRAs and 401ks, every penny of that is not really yours. We sometimes think about it as all of ours, but the reality is every dollar out of the traditional IRA and 401k has to be taxed someday. It's going to be taxed by us. If we're married, it'll be taxed at a joint rate until one of us were to pass on. And then there's a widow's penalty, and eventually it'll pass on to the kids, and they end up paying a kiddo's penalty. So we got to start looking at how we can do that. You don't want to go into retirement without it. Kiplinger's, this is a January article, says that we have a silent partner when it comes to our 401k, and the name is Uncle Sam. Every time Congress meets, there's a chance the government can decide to increase the IRS's share of savings, and quite frankly, you have nothing to say about that. A lot of times on the radio program, we will talk about, think of the IRA and the debt that's due towards taxes. Think of that as a mortgage on a house. If you had a mortgage on your house right now with low tax rates or low interest rates that we're in, you would be doing everything you could to either refinance at a lower rate, try to lock in a lower rate of interest on that mortgage, or if you thought interest rates were going to go higher, you would do everything you could to pay off the mortgage rates if it was adjustable, something that could go up before they go higher. Well, our IRAs are the same way. We have a mortgage against them. That mortgage is at future tax that has to get paid. We're currently at a 40-year low. How do I put myself in a situation so I can pay as much of that tax-deferred money at the lowest rate possible, assuming that it's not going to adjust or change our lifestyle in retirement? I think the number one lie we've been told, and it goes back to the 1980s, as we first started putting in money into these retirement accounts, we were all told the same thing. You're going to put money into these accounts. You're going to put them in a higher bracket. And then when you retire, you'll be in a lower bracket. But a lot of families are surprised to find out that by just waiting to start to move this money around to pay some of that tax now at 40-year lows, they actually could find themselves in a much higher rate, especially those of you that have done a good job saving. If you've been a good saver, you've got money set aside in these retirement accounts. I know that the balances in many cases have ballooned to a value that was far more than you ever thought you'd have. But by waiting at 72, we have to start taking out required minimum distributions. And that's where the problem comes in. A lot of families don't realize it, but there can be a time bomb just waiting for us because the IRS wants their cut and they're going to want to take their money out. And the biggest problem is that down the road, we could be in a situation where we're paying taxes at much higher rates just because we waited to take this money out. In fact, I wanted to bring in a quote from Ed Slott here, who's a good mentor of mine, somebody I've known for a long time. But he's telling us right now that we need to start shoveling as much of our retirement accounts into tax-free as we can, starting to put together a plan on how to get this money out, get it back. And all of this can be covered in what we call our tax smart retirement analysis. So again, if you don't feel like you have a plan at all, or maybe you need to dive in a little deeper to how we're going to take your money out so we don't get hurt by these, because as a joint owner with the IRS, sooner or later, all of these counts have to be done. And today's topic, just the 5 things we can be doing that the ultra wealthy do to save a small fortune, is really just kind of looking at these 5 areas. So it's a good time to review that. Let's move on to number 3. Number 3 is make sure you have a strategy to minimize taxes on Social Security benefits. According to Retirement Watch, your Social Security benefits are a stealth tax. One of the worst stealth taxes a retiree has when it comes to the income taxes on their Social Security retirement benefits. Some families aren't even aware that the taxes exist when they retire. Others feel like they might be exempt from them, and they don't realize that they're going to get hit with Social Security taxes until it's too late. Here's the thing. There isn't anybody listening to us right now, married or single, that would ever have to file a tax return again in retirement if the only income you needed to live on to maintain your lifestyle was through Social Security. Because Social Security, regardless of what they've told us, there isn't a person out there would ever have to file tax on Social Security if that's the only income you need. You see, only half of that goes towards what's called a provisional income. I'm going to get in the weeds here a little bit, but I promise to pull right out. That provisional income decides how much of the Social Security benefits get taxed. Families that are in the highest, we have families that can maximize their Social Security to even $70,000 or even low $80,000 a year. Even if you were at $80,000 a year, only half of that goes into the calculation. That puts you at 40. Of that, only 50% of 6,000. I'm getting kind of through this. We can walk you through it if you have any questions. But that really means only $3,000 of Social Security would even be taxable, even if you had $80,000 a year coming in from Social Security. And guess what? We get a little bit better than $25,000 a year as a standard deduction. It means that we're in a 0% bracket. It's only when other things come into play. Things like interest, dividends, maybe rental income. Those of you with pensions, maybe it's a situation where we can't get you to a tax rate 0 because you have a nice pension, but let's not pay more than our fair share because we ignore this. What happens is sometimes all of a sudden we take our Social Security, we have everything kind of lined up, and then 72 hits or required minimum distributions start coming out. On a $1 million 401k or IRA, that's $35,000 a year that has to start coming out. That's enough to start causing us not only taxes on the distribution from the IRA, but now we get socked twice. We get socked again with taxes on our Social Security. A lot of this can be avoided if we just start to look at these 5 areas of planning that I'm talking about here today. And it's all covered in what we call our Tax Smart Retirement Analysis. And we'll talk about that a little bit more here in just a second. But if you, again, this is available to everybody. If you are already a client of ours and we haven't sat down on this, let's review it. It's a great time. Summer, as we get into the fall here, there are some really smart strategies that a lot of our clients are doing to make sure that we are preparing ourselves for the second half of the year. I talked about this on the radio program just a couple days ago, but, let's think about it. We've got, COVID, very likely going to probably come back. I mean, they can't even decide what kind of schools are going to be open and what aren't, whether the universities will be open. I think that we're going to see an increase in COVID. That's probably going to do some things around our portfolios that maybe we want to start addressing. We have a low interest rate environments. It's hard to get a good rate of return on money that you don't want to expose to market risk. We also have a lot of different news out there around what they're doing with stimulus and such. That's going to, and we have an unprecedented election coming up here in November too. So a lot of things are going on. Your tax planning, wealth management, just simply investing strategies is different than I think what we do here at Secure Retirement. We talk about how to bring in look forward tax planning, and now is a great time to do it. Even if we don't take action here in August or September, let's decide what the game plan is going to be. If we start to see some volatility, what do we want to do? Make sure that we don't have too much money exposed to the risk if we need obligations and they're going to be pulling money out. And if we do, then let's look at some tax smart ways that we can take that money back, if that makes sense, and make sure you're in the best situation. So now's a perfect time as we get into August here, kind of running through the rest of the summer before things get kind of crazy again here. I expect to see a little bit more volatility as we get into fall, but who knows? So let's move on to the 4th thing. You want to take advantage of tax harvesting. Tax harvesting is making sure that we take and offset some of our take some losses here on some of these investments that might have come back a little bit on us. If you're in some of our managed portfolios, you know that there's some investments there that we could probably reposition. The IRS says I got to wait 30 days from the time I sell, or if I buy it beforehand, I got to wait 30 days to sell it to recognize a loss. So there's some ways we can do that. If you're using our exchange traded funds, exchange traded funds are a much more favorable way for us to manage your tax situation in a brokerage account, one that's going to be taxed every year. So outside of the IRA and the Roth IRAs, that money that kicks off a little 1099. Nice thing about an exchange traded fund, we have some. If you're in our portfolios now, we're already doing some of this. We're selling off. So a good example would be we have a little bit of sprinkling of some commodities. We have a little bit of gold and silver. We exchanged one of our ETFs for another one that represented gold and silver. You really still had the exposure to that asset category, but yet we were able to recognize a little bit of loss. Now we look at it, the market's up, and then that area is kind of up a little bit. It was actually a really good move, and yet we were still able to take some losses on that. We want to take a look at this. A lot of you that have mutual funds, we're going to find out here at the end of the year that the money manager inside these funds was buying and selling different things, and whether you own the mutual fund for just a few months or maybe you've owned it for the last decade, the positions in that mutual fund might have been opened or purchased a long time ago. And when they sell these off, you have to take your share of that gain, regardless if you were invested in the fund the whole time. One of the reasons why we encourage families not to own mutual funds with they're fine in your IRAs and 401ks, but when it comes, in fact, our 401k here at the office is in mutual funds. But if you have a brokerage account, one that you get taxed on every year, interest and dividends, there might be some more tax smart ways to look at that. And now is a good time to take advantage of tax harvesting that can help you reduce some of your income at the end of the year. You're able to offset up to $3,000 of income, but even if you have more than that, you can carry that forward. So you want to do that, and that's something that we do with their tax smart plan, and you want to do make sure that you're taking advantage of that. Finally, what are the wealthy doing that we can also take advantage of to put ourselves in a better situation tax-wise? Keep in mind, we talked about the very first thing is to make sure we have a plan in place in the first place. Let's start looking forward and looking at taxes. Number two, let's put a plan together around distributions of IRAs and 401ks. Many people just kind of go into retirement willy-nilly and they just start spending money. You want to make sure that we put some thought into this. Look at Social Security, take advantage of tax harvesting, and then finally, let's look at Roth IRAs to avoid higher taxes in the future. There's other ways that we can use this. A lot of you are familiar with the LIRPs, the life insurance retirement plans. We've even used municipal bonds, although not something we're really recommending right now in the lower interest rate environment. And even HSAs to some part. The problem is that HSAs, health savings accounts, are hard to get a whole lot of money in there unless you're farther away from retirement. So for most of us, Roth IRAs is a great way for us to move money into something that's more tax-free. Motley Fool says that the money in your IRA gets to grow completely tax-free and withdrawals aren't taxed in retirement. Traditional IRA withdrawals do get taxed, which leaves you to deal with the burden during your golden years. Furthermore, Roth IRAs are the only tax-advantaged retirement savings plan that don't impose required minimum distributions, that gives you more flexibility. Actually, it's more than just Roth IRAs. The LIRPs don't have the required distributions either. But by having that, it puts you in a better situation. And then go back to the Secure Act that was passed here in December of 2019, says that they eliminated the stretch. We've talked about this. If you aren't familiar with what I'm talking about right now, make sure you schedule some time. But the Secure Act says that now when we pass on our money to our kids someday or any of the other loved ones, unless it's a spouse, unless there's some specific situations where there's disabilities or something like that going on, most of our beneficiaries will have to liquidate the IRAs in a matter of 10 years. If they don't take that out systematically over that 10 years, they could end up having to take it all out after 10 years in one lump sum. It can cause a whole lot of problems down the road. Roth IRAs, while they still have to be liquidated over 10 years, they won't be taxable. So it's a much better solution there. And ultimately, it really comes down to, asking yourself, where do you think taxes are going to be? We really do talk about this just about every week. We talk about taxes. We talk about how taxes are very likely going to be higher. I believe now, with everything going on, including the most recent act by the president to go back to the $400 a week of extra unemployment and everything else. I'm not saying that they shouldn't be doing this, because I think that there's a whole lot to do. They got to keep the economy going, but boy, there's going to be a hangover from all this one day, and we need to start looking at it. Best case, I think we've got about 5 years, 2025. Worst case, it could be, sometime after next January. But let's start to put together a plan, because if you have an IRA, if you have a 401k, you can't think of all this as your money. You got to start thinking of it as a joint account between you and Uncle Sam. Now, if we don't put together a plan, then what ends up happening is that the retirement savings we thought we had ends up just being a fraction. But there's some good, easy, simple defensive strategies, and we want to share those with you with our 15 to 30 minute secured retirement tax smart retirement analysis. Again, this is available for everybody. If you're a current client of ours and you would like to readdress the tax planning that we've put in place for you, let's visit with you. We can do that virtually. We have more and more families that are comfortable visiting us with the office, so come on in the office. If you are somebody that hasn't, maybe you did visit with us, it's been several years, come on back. Let's review this. If somebody sent this to you as saying, hey, why don't you pay attention to hear what Joe Lucey says about taxes, and you'd like to take it, it's open to everybody. So best way to do it is to either call that phone number on the bottom, 952-460-3260, or you can always just schedule your review just by clicking the offer that I just presented there. So with that said, I don't know if there's going to be any questions this week. I've got a minute or so to answer a couple questions. Otherwise, we'll wrap this up and what have you. I don't see any questions yet. So we'll go ahead and wrap things up. So this week, we talked about 5 simple things that you can be doing that wealthy do to put themselves in a better situation tax-wise. First of all, understand we have created another $3.5 trillion of debt in a very short period of time. Taxes are on sale, and we need to be looking at how we can best take advantage of that. If we're in a low tax bracket now and we know we're going to be in a higher one down the road, well, that's the easy piece of planning. For some of you that are listening to us today, it's not going to be that easy. We got to make decisions because maybe we're still in our earning years, but we know that we've got this calendar working against us too. So let's start to put together a plan and something that we can't, it's somewhat uncertain. We don't know exactly how soon taxes go up, but those 5 areas you can plan around. First of all, put together a look forward plan. Number 2, make sure you got a plan around required distributions, IRA, 401k distributions. How do I take my retirement accounts back? How do I make sure I don't get hit by what Ed Slott calls a retirement time bomb? We have taxes around Social Security. By itself, Social Security is 100% tax-free to anybody listening to me. It's only when other incomes hit the tax return that they become taxable. Let's show you some proactive, simple defensive strategies you can use there. Now's a good time to look at your portfolio, see if there's some tax harvesting that can be done. And then finally, let's make sure we start looking at the Roth, the tax-free options that are available out there, things like Roth IRAs. So without any further ado, I am going to go ahead and end the call here today. I hope everybody has a great week. And again, we'll get this off to you. If you have anybody that you think would benefit from it, feel free to pass it on to somebody else. Have a great rest of your week.